I think Citi is one of the sponsors of this very meaningful project, and I'm so happy to have the chance to join your group to discuss what I know. Because I've been in banking for long. I've been in Citi for 27 years, and all along I've been in the corporate and commercial banking area in different functions. So I'd like to share with you my view, my experience in these startup social enterprises, and how to make you guys successful and move to the next stage. So the topic today is how to scale up. And when I think later on Michael will talk about the perspective of an investor, but I'll talk about the perspective of a bank. How banks look at companies, enterprises, and how to evaluate these companies and how we can help them. So there are 5 elements that I'm going to talk about today. The top 2, the industry and management, are what we call the qualitative factors that we look at. The bottom 3, capital structure, profitability, and liquidity, are the financial aspects, the quantitative aspects that we look at. So industry. So naturally, when banks look at a company, we look at the industry, what industry they're in. I think you know that in Hong Kong there are a lot of traditional industries like garment manufacturing, textile, electronics, printing, a lot. But I think in recent years, as we discussed before the session, there are a lot of new economy segments quickly evolving, also disrupting the traditional business. So I also talk about the industry or the new segments in that area. So first of all, we look at the industry trend. Naturally, the traditional industries, they are very mature. We don't see a lot of upside, but very stable or even declining. So first of all, we have to look at the industry, whether is it on an uptrend or stable or declining. Then we also look at the level of business risk, because there are in different industries, there are different business risks. For example, if, say, a car manufacturing plant, for example, then people have to invest a lot of money into the equipment, the capex. Then we see it as having a higher business risk, because then you have to have a lot of production to justify, to use the capacity. And then the market position is important. Some industries, you have a lot of players, each have a very small share, but in some industries, there are very big players occupying the top 5 or top 6 or top 7 or top 10, leaving very small rooms for other players. And then, very important is the key success factors. How would you success in any industry that, for example, a search firm, then you need a good network and good skills to source candidates to serve your clients. And we can name a few that there are, in each industry, there's a very important critical success factor. Like in the biotech industry, then perhaps the only important factor is your research capabilities. What drugs that you're doing the research. So this thing that we have to look at very carefully. And then peer comparison. We love to do peer comparison when look at the industry. Like for example, when we look at gas stations, we want to compare Shell, Caltex, together with a few other fields. So peer comparison is we always do. And then from all these things, look at the key risks and mitigants. Then we analyze whether we're going into this industry or not. And then management. Sorry. Management is a very important part when we look at the company. I think same as you guys, that when you start a new business, very important that people know you as the management. Whether they can trust you, that's perhaps the most important thing. There's one old saying in JP Morgan, a very old banker, that they only look at several things. Character, character, and character. So probably true. The character is most important. But easier said than done. Character, how do you make an assessment on character? What we look at, I think most important two things, integrity and commitment. If you're very, very committed in the business, I think you can't go wrong. If you have a very high level in integrity, I think today is a must, is a given. If you don't have any integrity, you're bound to fail. Then we look at the style and risk appetite and controls and risk management. I think those are the several that are becoming more and more important these days. We look at the risk appetite, meaning whether you're a risk taker or you're risk averse or you're neutral, what type of strategies will you take in a very risky environment? So I think to banks, this is important. And then controls and risk management, because nowadays that I think business, enterprise, you guys are facing a lot of risks, fraud risk, particularly this year. That we saw a very big uptick in the fraud risk, cyber attacks. So very important. You have the controls, that you have the ability to manage those risks. Very important to a bank. And what is your attitude with your business partners, like your suppliers, your customers, your banks, whether you have a cooperative attitude or you always take advantage of the other side? I think that's important. And then the experience and track records. Well, I know you guys many of you are startups, so you may not have a strong track records per se, but I think try to build one that show people examples that you can operate, you can still make profits even in a very adverse environment, and how you overcome the hurdles, how you create new opportunities. That's the track record that you need to build up. And then I think very important as a business is what value do you add? If you can't add any value, if your objective is only making profit, I think you're going to fail. You have to add a value to get your profits. So think about what value you can add, and whether you are a winner in the industry. Although it's a saturating or even declining industry, but if you are a winner, then I think you'll still be okay. But even in a very good industry, but you are not a winner, you are a loser, then you're bound to fail. So very important, what value you add will determine whether you're a winner or not. And then the strategies. I think you study in the textbook that you have to create competitive advantage. And what competitive advantage are you building? It's related to value, what value you build. Either you're a cost leader, you're very, very efficient in controlling your cost, building your margin, or you have a lot of specialization. Like for example, $1,000 or $2,000 a pair of jeans, then people are still willing to buy it because it's specialized, it's high quality, it's a good brand. So either way, that go for cost leadership or specialization. And then management of changes. This part, I think in the past, not so important as today, but it's getting more and more important because I think that the world is changing faster and faster. Later on, I'll also talk about forward compatibility. Oh, sorry, it's up there. I missed it. It's so an important part because when we look at the performance appraisal of us in the bank, last year we added forward compatibility. So you may ask, what is forward compatibility? It's something that not only will succeed today, but will make sure that the person will succeed tomorrow and the years after. So for example, what are the attributes of forward compatibility? It's something that we never put in our appraisal before. I think, for example, curiosity. I think 2-3 years ago, why people put curiosity into your assessment? But now it is. Whether you are a curious person who decide whether you are successful or not. If you have no curiosity, probably it's hard to survive. Second one is boldness. whether you're bold enough. But you may say I'm contradicting myself. I'm saying you need to be bold, and you need to be conservative or manage the risk. I think they exist together. They coexist. You need to be very bold to make changes to survive. But on the other hand, you need to have a good brake, like a car. When you run very, very fast, you still have to run very fast. Like your Porsche, you still have to run very fast, but you need to have a good brake so that whenever you need to brake, you need to stop, then you can. So I think this is what we call the forward compatibility. There are also other attributes about forward compatibility. It's so important a part that when we promote someone, our bosses will ask whether this person has the forward compatibility. If not, then probably a promotion will be hard. So moving on to the financial analysis part. First thing we look at capital structure. When you start a business, you have to buy something, you have to buy the asset. So buying the asset, either you borrow money from the bank or use your own money. So bank borrowings or equity. So it's very simple, two parts. Then banks will look at what is the ratio between borrowing and the equity. So naturally for a startup, it's a bit hard to borrow from banks. And you have to, as I said, you have to build up the track record. First open a bank account, and then to start operating, build up a track record, and then build up the trust from the bank. But in the very, very beginning, naturally you start with equity. I think Michael will later on talk about the equity that you're going to get and start your business. But on the way to grow the business, then you have to add some leverage into the company, because if you always use equity, even you're a very mature company, then your return will not be great, because you're always using your own money without leverage. Then your return will be lower. And later on, return is so important to the investor and the bosses. So leverage is a tricky part that you have to have some borrowings, but how to manage it at an acceptable level to everyone. So you may ask, what is the acceptable level of leverage? I cannot tell you a number because it varies. It varies depending on the situation. As I said, if you're a startup, then the leverage should be very low. If you have a very high business risk, then your leverage should be lower. If you have a lower business risk, say one example we always quote is if you're a trading company, if you're trading commodities, then perhaps you can have a 5-6 times leverage. It's okay because your business risk is very low. You can always turn your inventory receivables into money very, very quickly, very liquid. So you can afford a higher leverage. You can afford borrowing more from the bank. And then we also look at the quality of asset. Doesn't always mean that asset minus liability is your net worth. It's correct assuming your asset value is always there. But very often when we look at asset value, sometimes we also look at asset which is intangible, meaning is when you acquire someone, when you're paying more than the net asset, that the price you're paying is more than the net asset of the company. Then you create some intangible net worth, which when doing our analysis will take out those intangible assets, because we believe that one day when we need to liquidate the company, the intangible asset will not be there. So I think next thing is the profitability. Okay, good. Profitability is important in a sense that a business needs to be profitable in the long run, preferably in the short run as well, because the profitability will make sure that the company can sustain. So when we look at the profitability, we look at the trend, we look at the gross margin, also the net margin after paying all your rent, interest expense, depreciation. There was a net margin. And also, as I said, the cost structure is important. What we call the operating leverage is that your percentage of fixed cost versus your variable cost. I think ideally, your operating leverage is not very high, so that it's easier to break even. Your operating leverage is high, means you have a high level of fixed cost, then you have to have a certain volume to break even. So we see a high operating leverage will bring higher business risk, and then doesn't say it's good or bad. No, it's not good or bad. But if you have a high operating leverage, then perhaps you should have a lower financial leverage so that you can balance the risk. It's no good that if you have a high operating leverage and also have a high leverage, meaning, say, going back to the car manufacturing example, that you have a very, very high fixed cost because you have all the equipment there, but you also borrow heavily from banks. So whenever there's a downturn, that you may have liquidity problem because you don't have that level of orders to keep your factory running. So a bit dangerous when you have both high operating leverage and high financial leverage. So also the competition. The competition will determine your profit margin. When you operate in a very competitive industry, then you're bound to have lower profit margins. If the industry is not so competitive, perhaps you can get a higher margin. And also the last one is the demand change and customer preference. Because I think, again, a very important trend in the past few years is companies tend to focus a lot on customer satisfaction and customer preference. Like for us, we always do voice of client survey every year, very diligently, to ask opinions from the clients, how they think about us. And we also look at one very important index that we look at is the natural promoter score. It's something that banks start to look at. You have to rate us in a scale of 1 to 10. It's only the 9 and 10 that we are seeing you as a true promoter. Say from 5, 6 to 8, then it's neutral. But if it's below 5, then we have to minus some marks from the score. So the net promoter score is used by more and more corporates, especially banks, to look at whether our clients like us or not. Whether not only they like us, they also need to promote to their friends and colleagues and family and so on. So whether your business will be successful depends a lot of your client experience. And we also, say for example, of our bank, we also spend a lot of time, efforts, not only to get a survey, but also to work on the client experience. Because it's not only the product that is important. The client experience is equally important. I think one good example is Apple. I think if there are Apple users here, that I think you agree that the user experience is great. Then how do we learn from that? It's every bit that counts. Not only the product must be good, but the delivery, the perception, the experience has to be perfect in every aspect. So then applying to your businesses, same thing, that what is the client experience? If it's a good experience, then they will promote it. Then they'll refer to their friends. They believe they're doing something good for their friends if they can refer your business to them. And disruptors. So I think this is a term that we look at and examine very carefully because there are a lot more and more disruptors. One example, I think 10 years ago, when you travel, you go to a travel agent to buy a package or buy an air ticket or book the hotel. But now I don't think you go to a travel agent. You go to some portals to make your booking. They are the disruptors. We have a lot of customers in the online travel agent business. They are big disruptors. They are making a total change of the industry. That we don't go to traditional travel agent again. We go to them. We log on their website, do the booking, And there are a lot of things that perhaps they later on will do other than booking your travel. So disruptors are very important in the society. And then I think that this is the last topic I'll talk about, is liquidity. So I think you have a question. What caused the business failure? Of course, that there are different qualitative factors like management, like industry, like profitability, but what is causing a failure of the business is the liquidity. You only have to fail because of the cash flow problems. In the long run, if you don't make profit, then you have a cash flow problem later on. But what's killing the business immediately is the cash flow, is the liquidity. So we have to manage it very, very carefully. When we look at liquidity, sometimes when we look at it, also look at the financial reports, then one thing important is not to have a qualified opinion, because a qualified opinion will naturally raise a lot of concerns from banks. And then we also look at some ratio. In the beginning, we look at the asset conversion cycle, because every business has an asset conversion cycle or a cash cycle. That typically you buy inventories, you manufacture, you sell, waiting to collect money. So if your asset conversion cycle is smooth, it's fast, then it helps you a lot in the liquidity. And then we also look at debt to EBITDA. It's something that relates to how quickly you can amortize your debt. Typically, we look at 3, 3.5, 4 as a benchmark, meaning if you have $100 of debt, then if your EBITDA is, say, 25 or 30, then 3 or 4 years for you to fully amortize the debt. That's perhaps the level that we're looking at. But again, as I said, it's different in different industry segments. But typically, we need to make an assessment how the debt is going to be repaid. So I think that's it for my part. I think we can move to the Q&A later on when Michael finishes. Right. Okay. Thank you.